Hello everyone, this is Dr. Zaidi. Welcome to my YouTube channel ZTube. In this video, I'll be discussing about standard costing. Variances, what is variance? Variance is a difference between your budget and your actual results. What you have budgeted at the beginning of the period, or you expected, or you have forecasted, and the actual results. This will give you a variance. Now, variance can be good variance or a bad variance. Means a favorable variance is considered as a good variance and unfavorable is considered as a bad variance. Well, which is a topic of discussion. But at this point, what I'm going to ask you is, if you haven't watched my flexible budget video, you should go back and watch my flexible budget video first before you review the standard costing, because this video is built on my flexible budget video. The diagram you can see here is also coming from my flexible budget video. So this will be really helpful for you to understand standard costing when you have a background on flexible budgeting. So as you can see in the diagram, we have a static budget variance, and then we have two branches here, the activity variance and revenue and spending variance. So static budget variance is the combination. When you add activity variance and revenue and spending variance together, you get static budget variance. Or when you expand the static budget variance and split it into into two variants, becomes activity variance and the revenue and spending variance. So that's coming from our flexible budget. Also, the example solution from my flexible budget video is shown on this slide right here. This is a flexible budget performance report that I obtained from that video. It shows revenue and spending variance. If you see in this column, second last column, revenue and spending variance, which is also known as flexible budget variance, you have direct material variance, unfavorable, direct labor variance, unfavorable, and variable manufacturing overhead, favorable. So in this video, we'll be focusing on revenue and spending variance, and we'll try to figure out that how do we get these variances? What was the cause of the direct material variance? What was the cause of direct labor variance? Okay. Our next slide shows you the further division of the flexible budget variance. So as you can see here, from a static budget, we got activity variance and revenue and spending variance. But from flexible budget, we got a price variance and quantity variance. So now we go back here and we look at this $6,000 variance in direct material. What was the cause of it? All right, there could be two causes. One is the quantity, the other one is the price. The price would be you paid higher per unit of the wood that you bought, right? Or you paid higher price for per unit of a pound that you bought, or per pound. You paid higher price for per gallon of a gasoline that you bought. Okay, you paid higher price for per square feet of the space that you rented. So that's based on the price. You paid more price wise, you paid more on per unit basis. Okay, the other aspect is the quantity. You bought higher quantity, that's why the total cost of direct material is more. So instead of buying 10,000 pounds, you bought 20,000 pounds. Instead of buying 20,000 pounds, you bought 30,000 pounds. Instead of buying 20,000 gallon, you bought 30,000 gallon, right? So that way you can also pay higher cost for material, right? Same thing is with the labor. Either you hired the expensive labor, so instead of hiring someone for $10 an hour, you paid $12 an hour. So that's a price, right? You paid higher price. Or instead of them incurring 1 hour to produce something, they incur 2 hours to produce. That's also higher cost. If they spend, instead of 1 hour, they spend 2 hours on producing something, then you will have to pay them $20 instead of $10, because they are working on $10 an hour. So again, the cost will go up, and that will create a variance. So this information was not sufficient for us to find out that what was the cause of those variances, material variance or labor variance. So what we do here is we further divide into a price and quantity variance, whether the variance was due to paying the higher price or because we consumed more quantity, right? Or efficiency in terms of hours. If they spend more time, then it's less efficient. Okay, quantity in terms of material. So we have three different variances here. These are material price variance, labor rate variance, and overhead rate variance. Same thing with the quantity, material quantity variance, labor quantity variance, also labor efficiency variance, and overhead efficiency variance. Okay. You can also have more variance from revenue and spending variance, but this is the topic that we will be discussing, the price and the quantity, material, labor, and overhead in this video. So I highlighted these two, price and quantity here. Okay. Otherwise, the diagram may look like this. So from the revenue and spending budget or variance, you can have a sales price variance, you have a material variance, you have a labor variance, you have a variable overhead variance, you have a fixed overhead variance. They all are driven from the revenue and spending variance. From material, you have material price and quantity variance. From labor, you have rate variance and efficiency variance, variable overhead rate variance, and variable overhead efficiency variance. So these three, that's what we are going to discuss in this video. As you have seen here, these are the three: material, labor, and overhead. Price variance, material, labor, and overhead. Quantity variance. So that's right here we have. So this is what we are going to discuss today. So before we start discussing this, let's discuss about standard costing. What is standard? A standard is a benchmark or norm for measuring performance. If you see standard is kind of, you know, a small budget, right? When you make budget for a year, for a firm, for the total quantity of the product. Whereas you make a standard for each unit of a product. Instead of as a whole, you're going to buy 10,000, pounds of this, or you're going to sell 10,000 units, or you're going to, make this much money. You create a standard. It's just like budget is an umbrella, and a standard comes under that umbrella, right? So you make a standard for one unit, right? So you're producing one cell phone. How much material one cell phone is going to consume? How much plastic one cell phone is going to consume? How many hours one cell phone is going to take to produce, right? How much overhead you're going to consume when you produce one unit. So usually standards are set for one unit. Compared to budget, they are created for many more units. So these standards are created for quantity and cost, right? Cost is also known as the acquisition price, right? Cost you can say as a price, because usually in accounting and in business, whenever we discuss price means sales price. That means you're selling it to someone. That's the price. And when you say cost means that this is the cost of making something, right? Your cost. However, in standard costing, the cost is known as acquisition price, because cost is something that you pay to acquire something. And same as acquisition price, you pay someone to acquire something. That's the acquisition price. Acquisition price of acquiring labor, $10 an hour. Acquisition price for acquiring a material, $2 per pound. So that's the cost. So whenever we refer acquisition price, actual price, a standard price, from now on, it means the cost. It doesn't mean the sales price, okay? Or not necessarily means the sales price. So we create standards for quantity and cost, okay? So the price standards or the cost standards specify how much should be paid for each unit of input. Means how much are you going to pay for 1 pound of plastic? How much are you going to pay for 1 square feet of wood? How much are you going to pay for 1 gallon of a crude oil? So that's the cost of a unit. Okay. Whereas the quantity specify how much of an input should be used to make a product, okay, or provide a service. So how many hours are you going to take to make one cell phone? How many hours are you going to take to file this tax return? How many hours you're going to take to treat this patient? How many hours you're going to take to manufacture a computer? So that's the unit of an input, right? In terms of the quantity, okay? You can also do the unit of an input in terms of the material. How much material are you going to use? 2 pound of a material, 10 pound of a material, 3 square feet of a material, right? That's also a material. Price is how much you paid for per unit. Quantity is how much did you use to produce one unit, right? Then at the end of the period, we compare. We compare actual results with the standards, and we try to find out if there is a variance, which is the differences between the budgeted amount or standards and the actual amount. And if the variance is significant, then you investigate and find out the cause of the problem. And if you think that this can be eliminated, and then eliminate it. Okay, what is significant? Again, it depends on the company's guidelines. You can set significance level based on the dollar amount. You can set significance level based on the percentage amount, right? 5% above or 5% below. And if anything goes above 5%, you can say it is significant. If it is below 5%, then you can also consider that as significant. So that is management decision, how they decide that what is significant for them and what is not. The principle of exceptions basically sends them signal whenever the exceptional variance occurs. They send them the notices to the management that, okay, exceptional variance has occurred, please investigate, and managers go there and then they investigate and try to find out what was the reason of this extraordinary variance, and they try to eliminate it. If it's eliminated, okay, they try to find out the causes of those variances. Are those causes due to because the whole economy is slowing down, that's why we incurred, and there is nothing we can do to fix it, or because the prices are going up, the labor prices, the material prices are going up, or the transportation cost is going up. So if there is no control, they cannot fix this. But if there is a control, if they know that they can increase efficiency to reduce the variance, or if they can switch the vendor, the vendor, and they find more reliable vendor, and the vendor who can provide them cheaper raw material but the high quality or the same quality material at the lower price, then they can use them. Or alternatively, they can find a ways to fix the budget problems if they have made an errors in budgeting. Now you create standards for material, labor, and overhead. So how do you create is you create a standard for the price and you create a standard for the quantity. As you can see here, the standard price SP times the standard quantity SQ. So the standard price is the standard price that you pay for per unit of the material that you buy. So it could be per unit, the per pound of the plastic that you bought, or per square feet of the wood that you bought, or per gallon of the kerosene oil or the gasoline or the crude oil that you bought. So this is based on 1 unit, okay? 1 unit that you bought. And the quantity is based on standard quantity per unit, like 1 unit of an input that you're going to use the material for. So if you're going to use 2 pound of material per unit that you're going to produce, let's say you're producing a water bottle and you need a plastic for that, and you're going to need 2 pound of plastic, then the standard quantity per unit is the 2 pound of plastic per unit, right? Standard price would be how much you paid for per unit or per pound of plastic, and the standard quantity is how much you used, how much plastic you used to produce 1 unit. Okay, so that's how you determine the standard prices and standard quantity. Similarly, you set standards for labor. In a labor, you set standards for rate and standard for hours. Hours, determines efficiency or the quantity. So the rate, how much you pay on hourly basis, that will give you the standard rate of labor. And then the standard hours, how long it take them to make 1 unit. right? So if you're making water bottle and it takes them 5 hours to make one water bottle, then the standard hours per unit is 5 hours. What is the rate? You're paying them $10, so $10 is the standard rate times the standard hours, 5 hours, right? So that's how you determine the labor standard. Similarly, you determine the variable manufacturing overhead standards. Now you determine the rate. So standard rate is similar to the standard labor rate, but it's not a labor rate, it's variable manufacturing overhead rate, which can be determined by using the predetermined overhead rate. If you remember those formulas from my previous videos, you calculate the predetermined overhead rate when you divide the budgeted overhead divided by the budgeted activity based or cost driver. This will give you predetermined overhead rate. That overhead rate, you can use it here as a standard rate. And then you multiply with the standard hours. And standard hours is basically how long would it take them to make one unit if you are using the same labor hours. You can use machine hours or whatever the cost driver is here. You can use it, right? So if it's driven by machine hour, you use machine hour. If it's driven by labor hour, you use labor hour. Now, if the labor hours are used here, where you use the labor hours in standard hour for setting standard for labor, and same thing with the variable manufacturing overhead, you're using the labor hours, then if one variance is favorable, the other one is automatically going to be favorable. If one is negative, then the other one is automatically going to be negative. So remember that, and I'll show you with the formula when you will see that. Okay, so we have a variable portion of the predetermined overhead rate. So just like $10 an hour, $15, $16, and then we have the standard hours, right? The machine hours or labor hours, whatever is driving the cost, we can use that. And that's based on one unit of input, okay? Then we move on to the general model of standard costing. Now, we need to create the variances for material, and the material variances are based on the price and the quantity. Sometimes it's also known as material efficiency variance, the quantity variance. Direct labor variances are direct labor rate variance, which is sometimes also known as direct labor price variance. And then we have direct labor efficiency variance, which is also known as labor quantity variance. We have the manufacturing overhead variances. So we have variable manufacturing overhead variance, in which we have overhead rate variance. Variable overhead rate variance is also known as variable overhead price variance. And we also have overhead efficiency variance, which is also known as overhead quantity variance. In addition, for MOH, we also have fixed MOH variances, fixed manufacturing overhead variances. We have a budget variance and we have a volume variance. Okay, so our focus mostly for this video is going to be to focus on your direct materials, direct labor, and variable manufacturing overhead variances. Okay, so who uses a standard cost? Pretty much everyone uses. It doesn't matter whether the business is a service industry, lawyers, or the tax filing authorities, or doctors, or it's a merchandising businesses like Walmart and Costco, or it's the manufacturing companies like Procter and Gamble, General Electrics, or Johnson and Johnson. Pretty much everyone uses a standard cost. Setting a standard cost. Well, when we set a standard cost, we're basically encouraging efficient future operations, because we are comparing our budgets or our standards with our actual, which means we are controlling our costs. Okay. Now, when we set our standards, we need to remember that there's two kinds of standards. There is ideal standards or there are practical standards. Now, ideal standards are hard to achieve or pretty much impossible to achieve, because you have to be right 100%. Means you have a constant efficiency and your productivity is 100%. It's like if I said, if as a professor I said that, okay, anyone who gets 100% will pass the class. Anything below 100%, 99%, 98%, will fail the class. Now, what happens in that case? Students will take exam one time, maybe twice, and if they don't get 100%, they're like, oh, we are failing. Even if they're getting 98%, we are failing the class. So this will demotivate them. They end up dropping the class, right? So when you set ideal standards that are hard to achieve, this actually demotivates employees, and employees leave the job and they don't perform on those standards. So it's good if you establish practical standards. Practical standards are the standards that can be achieved with some efforts. So it's not like the easy standard that they can achieve, but if they put efforts, they can achieve, and they are rewarded for their efforts for too. So it's like, if I give, okay, 90% is an A, 80% is a B, mean with a significant effort, you can achieve those standards. Those are not the standards that are not achievable. But 100% just for passing a class, that's totally unachievable. Means that if a company is running, you expect that you are running 24/7. You expect that there is no strikes. You expect that there is no downtime. The machine is not shutting down. There is no breakage. There is no maintenance. It's constantly working, and all the employees are working 100% of the time. So those ideal standards are hard to achieve. Okay. So what is the model of our standard costing? So as you can see here, we have AQ times AP, AQ times SP, SQ times SP, right? So what is common here in the is that we have actual quantity times actual price. Actual quantity times standard price. Standard quantity times standard price. Just like the model we have for our flexible budgets. If you remember that at one extreme we had the actual, at the other extreme we had the static budget. So if you look at that, on that model in my flexible budget, this was on the left hand side, the static side, and this is the actual side was on the right hand side, and we created a flexible budget, right? So we just switched the order here. So the standard or static is on the right hand side, the actual is on the left hand side. Now we are creating something similar to flexible budget here, right? We took price from here and we took quantity from here, right? So we can compare, because those two, the actual and standard cannot be compared, because we cannot compare apple and oranges. So we have to have at least one in common in order to compare. Okay. So here is actual quantity times actual price minus actual quantity times standard price gives us price variance. Okay. Actual quantity times standard price minus standard quantity times standard price give us a quantity variance, right? This could be the price variance, or also known as rate variance. If it's a labor variance, is a rate. If it's an overhead variance, it's a rate. It's a quantity variance if it's a material. It's a time variance if it's a labor, or it's time variance if it's the overhead variance, right? Or you can also call it the efficiency variance. So the AQ in this case is the actual quantity or hours. AP is the actual price or rate. SQ is the standard quantity or hours. SP is the standard price or rate. Okay. Now, as you can see here, it says that actual quantity of input at actual price means the actual quantity, how many units, how many pounds of material you have used to produce 1 unit of output. Actual price is how much you have paid for 1 pound of that material that you used to produce 1 unit. Okay, so that's how you determine the actual price. Same thing is here, the actual quantity times standard price, the actual quantity of input at a standard price. So you took actual quantity from here and then standard price from here. What was the standard price? The standard price was the budgeted price, the price that you said that it will cost you this much to obtain this material. So $10 per pound to obtain that material. So that would be the budgeted price for that material that you're using, and that's the actual price you paid for per pound of material that you're using. And then Here we have a standard quantity and a standard price. So I already told you about the standard price. The standard quantity is the standard quantity allowed for actual output. So basically it's a combination of two things. It is the standard quantity of input at actual output. Okay, so as you can see here in the blue highlighted area, the standard quantity allowed or standard hours allowed is equal to the actual output in units time is standard input allowed per unit of output. Means what you budgeted, how much material you're going to use to produce one unit, right? What you budgeted, how much material you're going to use to produce one unit times actually how many units you have produced. So two things, the actual and the standard, and you're multiplying to just to get this SQ. So basically this part is actually three things, right? Because it's the standard quantity. Okay, so this will give you the quantity variance. Now the expansion of this diagram in the formulas will explain you more here. So if you see here, as I said earlier, the differences between AQ times AP and AQ times SP will give you price or rate variance, which can be seen here. MPV, material price variance, is equals to AQ times AP minus AQ times SP. And the difference between AQ times SP and SQ times SP will give you quantity variance, which you can see here in equation MQV equals to AQ times SP minus SQ times SP. All right. So what you do is, if you see here, the AQ is can be factored out, right? So it's a constant here. So we factored out AQ. We left with AP minus SP. So that's the formula for material price variance, which is equal to AQ times AP minus SP. And similarly, MQV, you can factor out SP, and then you left with AQ minus SQ in the bracket. So MQV is equal to SP times AQ minus SQ. Okay, so this is how you drive those formulas. The other formulas are driven from these two formulas, MPV and MQV. So if you remember MPV and MQV, you will have no problem remembering LRV and variable overhead rate variance. All right, you can see here I just replaced quantity as hours because the labor quantity or labor hours or labor efficiency is measured in hours, right? So I replaced in hours here, and the labor is paid on rate. So I just replaced R. Instead of referring as actual price, I referred actual rate, right? You can refer actual price if you like, standard minus standard rate. So the formula is technically the same. Similarly, same is the variable overhead rate. This is the same formula as the labor rate variance, actual hours, and then actual rate minus standard rate, actual rate minus standard rate. If you go towards labor efficiency variance, you will see standard price in terms of material, right? You can call it rate in terms of labor. The quantity of material here, the quantity of labor is hours, because hours are the labor is measured in the efficiency, right? So the standard quantity becomes the standard hour. So it's the same formula. Variable overhead efficiency is the same formula as labor efficiency variance. Now the important thing about those formulas is the parts that I highlighted on those. These are the most important part. Now material price variance has AQ times AP minus SP, and material quantity variance has SPU times AQ minus SQ. Now those AQ in the material price variance highlighted in the green, and AQ in the material quantity variance highlighted in the blue, they may or may not be the same. Okay, when they are not the same, material price variance, remember, is driven by the purchases, the material purchases, right? If you buy a lot of material, you end up paying a lot of money. So the price variance is driven by the quantity of material purchased. Okay, so this AQ is the quantity of material purchase. Material quantity variance is driven by the quantity of material used, right? You may buy a lot of pounds of plastic, you may buy a lot of gallons of crude oil, but you may not manufacture everything. All right. So the material quantity variance is driven by the quantity used. How much of the stuff that you bought, you used it, right? You may bought 10,000 pound, but you used only 8,000 pound. So then in MQV, you will report only 8,000 pound as actual quantity. Whereas in actual quantity in MPV, you will report 10,000 pound because you bought 10,000 pound. So MPV and MQV's AQ may be different. When they can be saved? When whatever you have purchased, you used. If you purchased 10,000 pound and you used all 10,000 pound, then it may be the same. So always remember that MPV is driven by the quantity purchase, MQV is driven by the quantity used. Another thing that you need to keep in mind is the standard quantity or standard hours. Now, as I said earlier, when you saw that blue um, diagram here, which says SQ is the standard hours allowed, which is the actual output in units times standard input allowed per unit. This is what it's showing you in highlighted, that this is not just SQ itself. This SQ means standard quantity allowed. Standard quantity allowed is standard quantity of input at actual output, right? So two things playing role here. How much of material you budgeted that you're going to use for per unit of an output times how many actual units you produce, right? So two things: standard quantity of input at actual output. So you have to multiply this to get two things. Same thing with the standard hours. Is not just standard hours, it's the standard hours of input at actual output. Remember, in standard costing, we always talk about 1 unit, right? First comes first. The unit comes first. Then we try to find out the whole cost and everything. But first we have to find out 1 unit. So standard hours of input at actual output. How long would it take? Like, this is the budgeted amount. How long would it take you to make 1 unit that you budgeted, right? You budgeted would take you 10 hours to make 1 unit. That's the standard hours of input. At actual output, how many actual units you have produced? You produce 10,000 units, right? So you multiply the standard hours of input at actual output. Same thing, you do it with the variable overhead efficiency variance. Whenever there is an SH, that means the standard hours of input at actual output, right? These are the standard hours allowed. So always keep that in mind. This can be seen here when you see the difference between the normal costing that we usually use and the standard costing. So in normal costing, this is the MOH account and work in process, right? If you remember that the overhead applied goes from MOH to work in process account, which is shown here. You debit work in process, you credit MOH, right? And how do you apply overhead? You have a predetermined overhead rate, which you can see here in the T account. Predetermined overhead rate times the actual hours or the actual activity level or the actually cost base, right? Or actual allocation base. So you have a predetermined overhead rate times the actual activity will give you the applied overhead. So that's what you're getting here, the applied overhead, and moves to work in process. In the standard costing, you have similar thing, but you have the standard hours allowed. So applied overhead, you're calculating in the same way. If you see predetermined overhead rate, you have predetermined overhead rate in the normal costing too. But in normal costing, you are just multiplying it to the actual hours. You got the actual hours. Here in standard costing, you are multiplying it to standard hours allowed. And remember, standard hours is two things: the standard hours of input at actual output. As you can see here in the red box, it says the standard hours of input at standard hours allowed for actual output, means standard hour of input at actual output. How long have you budgeted is going to take you to produce 1 unit times how many actual units you produce, right? So it has a standard component and it has the actual component. So that's the thing which differentiates it from the normal costing. Okay, so that standard hours allowed can be seen here in standard quantity, standard hours, and standard hours that I highlighted in yellow. Okay, so what are the advantages of standard costing? Well, standards are key elements in management by exception approach because it tells you when the exceptional uh, variance occurs and it gives signal to management. So management can take action. So they can control, they can make decisions, they can revise these standards. If standards are viewed reasonable by employees, it can promote economy or efficiency. As I said, if you give them ideal standards they are unable to achieve, they are going to be demotivated. They won't be able to achieve those standards. But if they are reasonable standards, then it can promote economy and efficiency in employees. Standards can also simplify bookkeeping, right? And it can fit naturally in an integrated system of responsibility accounting, because what is the purpose of responsibility accounting? To find out the causes of the variance, right? Find out the responsible department of the variances, right? If it's the cost variance, the cost center managers are responsible. If it's the revenue center managers are responsible for the revenue center related variance, or the profit center managers are responsible for the profit center. So you need to find out, but not for penalizing anyone, but to rectify the problem, right? The purpose of a standard is not to penalize the manager, but to rectify the problem. Now, there are several disadvantages of standard costing. First of all, the standard cost reports are outdated. They are outdated because you don't have actual results available until, after a few days, a few weeks. For example, if you're doing overhead variances and you're trying to wait for utility bills, you won't be able to make the standard costing reports because you don't have the overhead variances ready. So by the time you have the variance, you have the bill is out and you try to prepare the report, it's already too late for that particular month to revise the standard. So you have to wait for another month to revise for the following month standard. So sometimes they are outdated, so it create a problem. If managers are insensitive and use variance reports as a club, morale may suffer. So if they use that, oh, we want to punish employees for whoever they did not achieve the goal, then the morale is going to suffer. That's not the purpose, to punish the purchasing manager, production manager, or the quality control manager, that they didn't achieve the target, so they should be punished. No, the purpose is to improve the performance, right? Try to rectify it. If you start punishing employees based on not achieving their targets, and then the morale is going to suffer. Labor quantity and efficiency variance makes two important assumptions. What are those assumptions? That production process is labor pays, right? The computation assumes that labor is a variable cost. Now think about that. If you have seen labor contract of the labor union, sometimes a lot of labor unions write a contract in a way in which a labor gets paid even when there is less work. Means even if they work 40 hours, below 40 hours, they still get paid for the total 40 hours, right? Sometimes they have a no layoff policy in which that they get paid for at least 40 hours even when there is no work. But when they have a lot of work, they have overtime work, they don't get time and a half paid. They get paid for the work that they did. If they work 50 hours, they will get paid for 50 hours, but not time and a half for the 10 additional hours they work. They will get the regular pay. So sometimes they have a contract like that. If that's the case, then labor is not a variable cost. And then the efficiency variance cannot be affected by the price of the labor because it's not variable, or the quantity cannot be affected by that. The production process may not be labor pace. For example, that you assume that, oh, if when you add more and more labor is going to increase efficiency. No, maybe it becomes dysfunctional, that when you add more labor, they start talking to each other and they work less, and it makes dysfunctional. So or maybe the machine doesn't allow, the machine can handle only up to 2 or 3 workers. So even if you add 10 workers, there will be a production bottleneck. It doesn't matter how much the workers work, they won't be able to process the units beyond a certain points when there is a bottleneck issue. So the production process may or may not be labor pays, and the labor efficiency variance and quantity variance assumes that the labor is a variable cost and labor is a production is the labor pace, which may or may not be the true. In some cases, favorable variances can be as bad or worse than the other unfavorable variance. So a lot of time that you will see that the purchasing managers bought a cheap material. Now buying a cheap material can create a favorable variance in purchasing department, but can create unfavorable variances in other department. For example, that it can increase the production cost in production department because they keep breaking on material, so the production cost increase, right? It can also increase the cost of labor because now labor have to handle material carefully, so they take longer time to work on one unit, so which will increase the labor cost on per unit basis. Okay, then it can increase the cost down the road when the merchandise goes or your product goes out in the market and labor and your customers return because they're not happy with the quality of the product. So overall you may end up losing the business in the end. Similarly with the labor, if your labor is not well trained, if you buy a cheap labor, yes, it will give you favorable labor variance, but then what happens, then again the production department suffer because the labor was not trained, so they start breaking material, so then production cost went up. Also they spent more on paying to labor because now labor was not trained, they couldn't produce, so they have to work more on the same units that they were producing, so they end up paying actually more than what they were supposed to. So in some cases, a favorable variance can be bad for the company. Too much emphasis on meeting the standard may overshadow other important objectives. So if you just rely on a standard, we have to meet this standard, we have to meet this standard, management may forget there's something important, more important than this. And what labor may do is they just try to wait until the end of the period and they try to rush the orders that, okay, we need to finish and make these standards and follow those standards and then achieve those goals, and then they try to do things to achieve goals in the short run which can hurt firms profitability in the long run. Just meeting standards may not be sufficient. You need to work on improving those standards. You need to work on improving the processes, right? Kaizen costing. Continuous improvement is required. Just meeting the standard is not sufficient. Next time your standard should be toughened up, and then you should be able to work on improving yourself constantly. Thank you for watching my video. Please subscribe my channel for live updates.